Breaking news, and a massive shake-up to Australia's property market is locked in.
Australia has around $4.5 trillion in super. Around a quarter of that money is in about 653,000 self-managed super funds. So,
big news coming out today from the government banning self-managed super fund lending.
In the Albanese Government's shake-up to self-managed super funds blindsided the sector, but the ban on residential property borrowing hasn't slowed investors down. It's actually just pushed them overseas.
Residential SMSF lending has fundamentally changed since the May budget outcomes. This is more than a legislative change. It has the potential to reshape future investor behaviours.
Tax breaks on loss-making rentals are being phased out, with negative gearing now only allowed on properties that were bought before budget night on May 12 and on new builds from July next year.
Rather than focusing only on today's impact, lenders should be asking where future lending demand is likely to emerge. Look, markets constantly evolve. Investor capital doesn't disappear due to legislative changes. Investors adapt when market conditions change.
Winding back investor demand is part of the reason why Labor is changing tax concessions on rental properties.
These concessions have fundamentally distorted our housing market. The current tax arrangements tip the balance against first home buyers, and that's why we're changing them.
The real opportunity here is understanding where investor demand is headed next. Where will capital flow? I think there's many options around where investor capital will flow. Things like commercial property, business real property, mixed-use developments, trusts and company investment structures, more sophisticated property-backed lending opportunities. Investors, they'll continue to seek strong returns. They'll simply use different investment and security pathways. I believe investors are highly adaptable. Capital always follows opportunity. It's a risk versus reward outcome being sought. Sophisticated investors don't leave the market, they reposition themselves. The new legislation may change behaviours, but not the desire to invest.
One part of the market is bucking the trend.
We call them mum and dad investors. We're finding a lot of either business owners or investors buying commercial property using their self-managed super fund.
According to Tim Cooney, it's possible for new investors to buy $1 million commercial property with around $200,000 to $300,000 from their super.
Better returns, longer leases, low maintenance.
We target returns of 5 to 6%, which is significantly more than what the residential market's returning at the moment.
I think investor demand isn't disappearing, it's evolving. As capital moves, lenders have an opportunity to follow new areas of demand. This is a chance to diversify beyond traditional residential SMSF LRBA lending. The next phase of growth may come from lending categories that have traditionally been more specialised. Growth comes from adapting to where the market is heading, a bit more forward-looking. I think as the market changes, it's likely that we'll see more complex borrowing structures, larger and more sophisticated transactions, greater legal and operational complexity. Lenders with the capability to manage this complexity may be better positioned for future growth opportunities. Look, absolutely. I think markets evolve and lending products evolve with them. We would expect lenders to explore new commercial offerings, structured lending solutions and specialist products. Product innovation will become increasingly important. The lenders that innovate early will be well positioned for future growth. The future isn't going to be just new borrowers, it's new lending solutions too. I think there's many points to think about with the new product offerings. The legal design of the product, the credit policy alignment, how it's documented, regulatory compliance, operational processes and workflows, the settlement process, and making sure that a product is scalable from day one. A great lending product needs the right legal and operational foundations for growth. I think there's numerous challenges for lenders in this area around loan structuring, trusts and corporate borrowers, security arrangements, general documentation and settlement coordination, managing execution risk from approval through to settlement, and even marketing. Here at Green Mortgage Lawyers, we support lenders as lending becomes more sophisticated. We don't just document loans, we help lenders build capability. We work with lenders to design and implement new lending products. We advise on the legal structure and documentation. We help ensure products are operationally practical and scalable. We support the implementation from product development through to settlement. We become a strategic partner as lenders evolve. GML helps lenders confidently bring new lending ideas to the market. I think there's a big shift in the lending market. Investor demand will continue to evolve. Commercial and structured lending will become increasingly important. Complexity will become a competitive differentiator. And the lenders who prepare now will be best placed to capture future growth. Don't focus on what's changing today. Focus on what's changing next. Invest in your capabilities, not just products. Make sure your legal, operational and settlement frameworks are ready for more sophisticated transactions. The future of lending isn't about doing more of the same, it's about being ready for the next generation of investor demand. Markets don't just stand still, and neither do investors nor lenders. While one chapter of lending may be changing, another is already emerging. The opportunity now is for lenders to understand where that demand is heading and ensure they have the capability, systems and partners in place to support it. That's exactly where GML helps our clients to succeed.